Healthcare stocks have had a rough year. Hospitals, insurers, even big pharmaceutical companies feeling the pressure. But there are some companies that are able to thrive in this tough environment. Joining us now with more is Ram Sampath, Associate for Portfolio Research with TD Asset Management. Great to have you back on the program.
Thanks. It's good to be back.
It's an interesting space. There's a lot going on. Let's talk about some of that pressure I was just referencing. What is going on out there?
If you look back at healthcare, what's happened over the last 2 years, it's kind of been a slow bleed relative to the S&P 500. So I brought a chart with me just to show what has happened over the last 2 years. Looking at it, we saw that there was an increase in sales of COVID-19 vaccines, the boosters, and testing kits. All of that ended in 2022, which is right where the peak was. And then it was a slow bleed in 2023 as COVID revenues were rolling over and companies like Pfizer and Moderna saw their revenues plummet. In 2024, the story was slightly different. There was a threefold issue. One was in pharma. So within pharma, you had big pharma names who had phase 3 trials and had failures in them. So one such company was in the beginning of 2024 was Biogen, which had a failure in their product. Second one was at the end of 2024, Novo Nordisk, which is your typical weight loss drug, they had their phase 3 trial and their weight loss was not up to par. Moving on from pharma, you looked at hospitals. Hospitals were seeing this staffing issue. So as they were understaffed, that means they had to overpay. You still had to run hospitals, which means that that's negative for them in terms of bottom line. And finally, insurers, what happened to them? They were looking at more people who were just more sick. So as soon as you have more sick people, you have more claims. That means you'd have to pay out more, which means that the landscape in entirety did not work at all over the last 2 years.
Okay, so those are the challenges and the pressures. There actually have been little pockets of it, though, that are, maybe even use the word thriving. What's going on there?
I mean, just before we get to that, there is a huge difference between Canada and US and how the healthcare system works. In Canada, you have a single payer system. Government pays for it, you're done, low administrative costs. But in the US, it's not the same. So if you have a job and a good paying job, your insurer, you'd have private insurance and they would cover for you. If you're above 65, then you have something called as Medicare, where the government pays for you and you might have to pay a little bit of premium in order to be covered. But if you have a job, but you are in the lower income bracket, you fall under Medicaid, where the government again pays for you. This is a very, very complicated system. So in order to look at how the system works, there are some efficiencies which you can gain. And some of the companies actually delve into the process of creating efficiency. And those are the companies which are thriving. One such instance, which I would call out, is Optum. So irrespective of whether insurers are having higher claims, hospitals are seeing more people inside, or pharma drug is seeing failures, you still have to do compliance and claims compliance, right? So people are still going to claim. And so Optum, which is a part of United Health, does all these for you. And in 2024, that was $1 trillion of claims which they had to pay out.
Okay, so interesting name there. Yeah, it is complicated, right? You did a nice breakdown of how the U.S. healthcare system works. I couldn't have done that on the fly. Let's talk about some of the areas that are still seeing steady profits. What's going on out there?
Yeah, so if you think about steady profits, let's go to the example of you owning a home, right? And the first things you want to show in your home is, hey, like it's completely painted. My wooden floor is really good. My shingles are not broken. But you never think about the plumbing of your house, right? And these are the companies which are essentially the plumbing part of your house. Until it's broken, you don't care about it.
You don't think about it. It's behind the wall. It's behind the drywall. Not thinking about it.
Exactly. And so companies like Optum, for instance, what they're doing is they're leveraging AI in order to do their plumbing better. So what used to take a week in order for claims to get paid now actually takes 7 minutes. And so the world is getting transitioned into a phase where you see on the other side of news where tech talks about DeepSeek and the cost of inference coming down. Healthcare companies benefit because the cost of inference is coming down, and they can implement whatever is there. Another instance which I'd call out is a company called as IQVIA. They are this massive data analytics company. They have all the patient data. They know about their previous outcomes. What this does is it basically tells patient A is suffering from a disease A, and company C is looking at a drug which can fix patient A. So they can go into the trials much faster, and you'd get outcomes much faster as well.
Fascinating stuff. One thing when we talk about healthcare stocks, it's hard to sort of escape the regulatory environment. When we think about names like this, is part of the risk there over-regulation?
It is. It is two sides of the coin. One is over-regulation. So we spoke about Medicare Advantage briefly. That's where the government is scrutinizing and saying, we've been paying a lot of bills on Medicare Advantage, and we want to cut costs down. So they're breathing down the insurer's neck and figuring out, saying, there is a way to fix the amount of budget which is going into people who are greater than 65. And so insurers are getting pinched because now they have lesser room to have claims paid out, which means that that's a shrink on their margins. The second part of it is people who are benefiting out of regulations. So a company like McKesson, they are a massive distributor. Think of it like a FedEx or a UPS, but for pharmaceutical drugs. They benefit from this space because as we are moving to more complicated and specialized drugs, the specialty drug transformation which is happening right now is actually positive to them. One instance I'll tell you is cell and gene therapy. Each drug costs between $1 million and $4.5 million. And in order to transport them, they take around $10,000 for one drug. And these are temperature controlled, which can go up to like negative 200 degrees. Even cancer drugs cost around $500,000, and they charge $5,000 in order to transport them completely.
Fascinating stuff. So there's a lot going on in the space. There's a lot of different little pieces to it. If an investor listening to this conversation, what's the takeaway if they're trying to find some opportunities in the space?
There are niche and specific opportunities in the space. One we had spoken about is distributors. McKesson, who does the specialty distribution, is poised very well at the space where they are right now. So specialty drug distribution, which we spoke about, is now close to around 35% of total drug distribution, is expected to go to 55% in 2027. So that's a massive TAM increase. And companies in the distribution space, whether it's McKesson and Cencora or Cardinal, all benefit because they are positioned there. Another interesting space would be Intuitive Surgical, which is your robotic arm. Basically, what they're doing is they have this new robotic arm, which means that procedures in hospitals have a lesser outcome of failure. What they're doing is you don't have to buy the product outright, but they're creating a service-based model where you pay monthly to use their products.